Okay, hello everybody. I think we shall commence this webinar. My name is Ali Hassan. I'm absolutely delighted to be providing the opening remarks for this webinar and indeed participating in what I hope you will find to be an insightful webinar looking at the future of private equity and venture capital with a focus on the Middle East and wider region. By way of background, I lead international coverage for the DIFC. I've been involved with the centre for 18 of its 19 years. I probably know many of you that are on this webinar. I was in Dubai for 8 years as a regulator with the DFSA, having spent 6 years with the FSA in the UK. So now DIFC is a multi-decade initiative created in 2004 as part of Dubai's long-term economic strategy, and having evolved into a global financial center ranked in the top quartile and number one in the Miaza region. 37,000 people, 700 plus regulated entities, 800 plus innovation companies, 4,500 companies overall, including professional services providers such as law firms, accounting, audit, and fund administration. A complete ecosystem for asset management and, with the focus today, private equity and venture capital for firms looking at asset raising and indeed deployment. Now, the secret sauce of the centre has been very much from the get-go the adherence to international standards of law and regulation. It's a bona fide common law legal environment with a regulator, the DFSA, operating in line with international norms. In the DIFC, we see regulation as an enabler, facilitating new business models as we seek to capture the future of finance. So DFSA over the last 2 or 3 years has issued comprehensive regulations for payments, for digital assets and crypto tokens, supporting the significant migration of innovation companies that we've seen into the DIFC, and facilitating the regime for venture capital with the rollout of a proportionate regulatory regime for VC firms. This certainty that this ecosystem provides, of course, is coupled with the business-friendly aspects of the DIFC and Dubai's global standing as a global commercial hub, which has made the DIFC a natural choice for international and regional financial firms looking to access the growth opportunities presented by the Miaza region. This is a region with growth and diversifying economies, significant asset pools, and structural positive trends around capital flows, capital markets, talent, and wealth migration. In relation to private equity and venture capital, the region offers GPs and LPs the potential for portfolio diversification and potentially higher returns than, say, in Europe and North America. The sovereign LPs of the region are allocating more to alternatives, and I think we'll see more of that with Angela's presentation, more to private equity and venture capital, and equally as importantly, private wealth is also looking to get involved in the space. So whilst we see in the DIFC and the wider region a pretty positive outlook, the global macro environment for capital, for private equity and venture capital, has changed over the last 12 months and is more challenging. And so it's timely to consider what this divergence may mean for private equity and VC trends going forward. So to discuss those points and more, we have a great lineup of speakers for you today, a great panel, a great presentation. And so we'll kick off with that presentation from Angela Nye of Preqin. Over to you, Angela.
Thank you very much, Ali. It's definitely my great pleasure today to share some market insights with you using our data at Preqin. Today's topic is the future of private equity and venture capital. But to begin with, I'd like to share a little bit also about the present and the immediate recent past, since it will help provide a little bit more context in terms of what to expect going forward. And then we will definitely touch on the outlook using some performance data as well as our investor surveys. So thank you very much. First of all, let's look at the private capital market. And when we do that, we like to keep a finger firstly on the fundraising results, because it's a great way to gauge the overall sentiment as well as the upcoming supply of dry powder. So on this slide, on the left-hand side, we can see that in year 2022, overall, it was a weaker fundraising year compared to 21, which was very exceptional. And that applies to almost all asset classes. And as higher inflation and interest rates set into the market, there's increased concerns around the overall economic conditions globally and has slowed investors' pace in making new commitments. So if we just focus on private equity first, and that would be the part in dark blue, we can see that fundraising has pulled back in 22, although in the first half this year so far, it looks to track a similar pace of fundraising with around $300 billion raised, and that's around half of the previous year. But turning to venture capital, which would be the magenta, the pink part of the bars, fundraising had very strong momentum in the first half of 22, and that propped up the full year results. But as market sentiment really weakened in the second half of 22, that really took a turn. And in the first 6 months of this year, VC funds globally raised around $60 billion, and that's just shy of around 30% of the 2022 full year total. And so we can see that the weaker market sentiment has also caused a slowdown in the rate of deployment into deals as well, and that's on the right-hand side. Here I'm just showing private equity buyout deals by region. And we could see that activity has approximately halved from the highs of 2021. And especially in these last few quarters, we see that activity is actually slightly below the pre-pandemic levels. If we could just move on to the next slide, because we mentioned that private equity fundraising was relatively better than venture capital, I think you'd be interested to just see some valuations data, which might help corroborate the divergence and the market view. So on the left-hand side, we're looking at private equity entry multiples, and that's in the magenta line, plotted against S&P for your reference. And overall, we see that private equity entry multiples have been relatively flat compared to public markets. Part of this has to do with the nature of private equity valuations, which tend to be priced using longer-term benchmarks rather than on a spot basis. So that does limit the volatility compared to public equities, although there are some differences across industries. So for example, technology buyouts, we see their multiples to have come down around 30% from their peak a year ago. And another reason for the slightly flatter trend is that the lower transaction volumes in the market right now suggest that investors are being very selective. So the transactions that take place and therefore go into this data tends to be biased towards the better assets that are still, of course, fetching relatively better valuations. So the less desirable assets, we see they might be holding off on deals while pending more favorable market conditions to return. And then on the other hand, let's look at venture capital. That's on the right-hand side. In short, we're looking at venture capital down rounds data. So as venture capital companies require new funding, they need to come to investors, and that's when you can't really avoid the valuation question. We can see that if you look at the dark blue line on top, down rounds as a proportion of overall deals in venture capital has come up towards the end of 22. And in the latest data, we see that around 10% of companies, 10% of venture capital companies are seeing their valuations come down in the latest round of funding. And so using this as a leading indicator, we could say that this points to slightly more correction in venture capital performance in the near term, and probably a little more than in private equity. And in the next slide, we're going to look at the actual performance. So next slide, please. In the next slide, we'll be looking at the Preqin quarterly indices for venture capital and private equity performance. Yes, thank you. So the top line is private equity, that's in dark blue. And then the bright blue, slightly below that, is venture capital. And you can see that venture capital in 22 has been down by 20% already, whereas for private equity, it's down by a much milder, just 4.5%. And in the first quarter so far, both private equity and venture capital have held relatively steady to maybe slightly up. And overall, it's still quite in line with the trend of the valuations data we saw just now. So with this in mind, let's go to the next slide. And we can see how investors are adjusting their near-term allocation sort of strategy. This comes from our global investor survey, where we ask respondents to indicate the expected capital commitment. And let me explain how to look at this. The solid colors represent the next 12 months intentions, whereas the semi-transparent colors represent longer-term intentions. And in short, if we look at the near-term expectations first, so the solid colors, if we can go back to the slide just before this. Yeah, this is the right one. Thank you. The bright blue at the top of the columns represent the proportion of investors intending to allocate less capital to the asset class. And we can see that around 30% of investors are considering decreasing their allocations to venture capital, whereas for private equity, it's a lot less. So this is quite consistent, I think, with the fundraising data that we saw earlier on, and does reflect, well, in the same survey, not shown here, but we observed more optimism as well from private equity investors towards their near-term performance expectations of their portfolio. So I think the other thing we should really have a look at is in the longer term view, which is the transparent bars, you can see that investors generally are actually more positive. We have more investors indicating a preference to allocate more to both private equity as well as venture capital in the long term than in the short term. So this does show that what we see, the pullback in fundraising, could be a shorter term sort of pivot as more investors perhaps are waiting for more visibility in terms of the economic outlook worldwide. So if we can just go to the next slide. I'd like to just show the Middle East investor survey. What I'm showing here is pretty much the same question, but for only exclusively Middle East investors. And we see that compared to global investors, it's mostly, the pattern is similar, but I'd say that Middle East investors are relatively more positive on private equity than the global counterparts. And we could also look at on the right-hand side, where we asked investors to identify the most attractive asset class they see in the next 12 months. And this is quite clear. We see that private equity now ranks top with the Middle East investors, whereas venture capital used to be top the last time, but that kind of swapped places. So that does show that there is a preference for private equity for Middle East investors. And in the interest of time, I'm just going to quickly share our long-term forecast. Basically, Preqin expects private capital AUM to be growing to actually double over the next 5 years through to 2027, reaching more than $18 trillion from currently around 9. And the main growth drivers will continue to be private equity and venture capital. And even though we expect fundraising to slow down slightly overall compared to the exceptional period immediately before this, we could see a little bit more participation from the private wealth segment, something that Ali also mentioned before in the introduction. So that could slightly offset the limitations of the institutional investors that we see now, perhaps in terms of the denominator effect, etc. So we also expect that exits might slow down, and with that, because that would extend holding periods of investments that will stay inside asset under management for longer, also providing a support to the AUM. But our overall long-term view for private capital is still positive. We think that the long-term return will still be decent, even with a little bit of moderation, and would still be worthwhile for investors to consider, especially given the diversification benefits that this asset class has to offer. So even though we are currently working to update these forecasts, and they will come out in October, we expect that there might be a little bit of downward revision, but overall, I think think we should still expect to see positive growth trend going forward. And so I think that should bring us to the end of my presentation. Here's a summary slide, but in the interest of time, I think we could actually go straight into the panel discussion, because if you're interested and would like to keep a copy of these slides for your reference, at the end of the presentation, there will be a code for you to scan, and you could download a copy for your future reference. So with that, I think, well, thank you very much, first of all, for staying with me. And I'd like to move on to our panel discussion. And just a gentle reminder, even though we have prepared some points to kickstart the discussion, we would also like to hear from the audience. So please feel free to send in your questions at any time, and we will try our best to address them during the Q&A session. So we have very esteemed members from the industry today to join us on the panel. Firstly, we have Ali, who obviously needs no further introduction. Thank you and welcome back. And then we also have Dr. Helmut, we have Khaled, and we have Said. And I think it's best to invite each of them to give us a brief introduction of themselves. I guess we'd go by order of the pictures. If we could start with Dr. Helmut, please. If you could just give us a very quick intro. Dr. Helmut seems to be still on mute. Oh,
sorry.
You're back on. That's fine.
Somebody had muted me. My name is Helmut Schüssler. I'm the chairman and CEO of TVM Capital Healthcare. My background is 35 years of healthcare investing, first in Europe and in the US, and for the last 15 years I've been in the Middle East, and we are now also active in Singapore. Our focus is growth capital. We invest in relatively young businesses, and we help them grow to a size where they would become interesting acquisition targets for larger funds than we are, or even the stock market. So that's our business.
Thank you very much. We'd definitely like to dig into your healthcare expertise later on. And then Khaled, please.
Yeah, thank you, Angela. So my name is Khaled Talhouni. I'm managing partner at Nua Capital. We're a early stage focused venture capital firm. We're about 3 years old. Our first fund's a $100 million fund. We're in the process of also launching a late-stage growth fund and also working potentially on a private credit product in the future as well. We see ourselves as the innovation asset manager for the region as a whole. My background is I've been in the early-stage innovation investing space in emerging markets, better part of 15 years, primarily Middle East, North Africa, Turkey, Sub-Saharan Africa, East Africa, and a little bit of Southeast Asia, but primarily GCC, Egypt, and Turkey. Have across my career invested in over 300 early-stage companies across different sectors.
Thank you very much. And last but not least, could we go to Said, please?
Thank you for having me. Said Murad here. I'm a partner at Global Ventures. Global Ventures started in 2018. We're a VC firm that invests across Middle East and Africa around the Series A stage, so also early stage, similar to Khaled and Nua. And we're sector agnostic in our deployment. On a personal level, my background is I'm born and raised in Jordan and have been in the UAE for the past 17 years, worked across private equity, banking and consulting, as well as operating companies, also within the startup ecosystem, most recently before Global Ventures, where I've been for the past 4 years. Thanks for having me.
Thank you very much. I think we definitely have a very interesting discussion to look forward to. But before we jump right into that, could I invite Ali back again? Could you firstly share some of your initial thoughts? Because, well, just now at the presentation, we looked at PEVC quite broadly from a global perspective. I think it would be really great to hear some regional insights on the ground in the Middle East. Do you see Middle East investors share similar global views that we looked at just now? And also in terms of the investment landscape, are there some differences, some unique aspects that we should be aware of and know about?
Yeah, thanks very much, Angela. Well, let me kick off the discussion on this point, and then the greater experts can come in. I mean, generally in terms of overall trends, in 2022, the DIFC had its best year ever in terms of firms coming in, financial firms coming into the centre, and 2023 has continued in the same vein. So we're definitely seeing that the region, in terms of its profile, in terms of the opportunities that it represents, is front of mind for financial services firms who are responding to the particular attributes of the centre. I kind of mentioned that, or the region. I kind of mentioned that in my welcome remarks, but it's worth just sort of stressing that whilst elsewhere in other geographies, the traditional investors are pulling back or reticent of being buffeted by, whether it's volatility in public markets or interest rates, or they maxed out on their exposure to PE and VC. That dynamic in those markets is not the same dynamic as we're seeing in the Middle East. You have large capital surpluses. You have existing investable asset pools that are significant, and as you mentioned, Angela, there is an addition allocation that's been looked at in terms of PE and VC. So really, that's been driving interest in financial services across the board, but also, and I'll mention, subsequently, GPs, committing to the region. And I think one of the questions that PE firms, global PE firms and GPs should ask themselves is it still viable to be flying in and out of this region that's presenting such opportunities, at this stage, or whether actually now and going forward that there needs to be a shift in that type of thinking.
Thank you very much. You definitely brought up a very good point, and I think that's really the first burning question we want to ask about, because just now we saw fundraising to be quite weak globally. So when you mention large capital surpluses, definitely a big positive for the region, and especially since fundraising has been challenging elsewhere in the world. And I definitely hear that there's a lot of interest in fundraising from Middle East investors. Could perhaps we share a little bit more insight in regards to what might be the most important considerations for Middle East investors right now? And are there any ways where Middle East investors are different from their global counterparts? Anything that we should be aware of, please? I guess because Ellie, you just spoke, perhaps we can ask Dr. Helmut.
Yep. Thank you. Just want to make sure that I'm not on mute. Yeah, fine.
You're good.
Well, I have a couple of thoughts in this regard, and that the first question is, how are Middle Eastern, let's call them in limited partners, right? We're talking about the private equity and venture capital industry, how they're different. And I think they're different in two main aspects. One is that first, they usually compete with you as a GP, because they are very often, when it comes to families, they are diversified conglomerates. And one arm of the business is a family office, and that family office makes investments. But of course, it is not an isolated matter. It always comes out of the family's business, and the family's business could be anywhere, real estate or food and beverage. But they then decide to want to go into another industry, and they put their resources into it. And so whenever you approach families, you always have to be aware as a GP that you're talking to potential partners, but also potential competitors. So that is my experience. I've been here for 15 years, and it's just one of the elements. The second one is that up until very recently, most people in the Middle East actually saw their family office deployment as a way to diversify risk. And therefore, they actually focused on investments outside of the region. And because they're also quite big, and and they like brand names, they have very much focused, and that actually goes for the families, for the big families, as well as the sovereign wealth funds. They really focus to this day on brand names. It's the Blackstones and the KKRs and the Carlyles and the TPGs and the Apollos that are taking in a lot of capital from the Middle East. And they take it in large chunks, by and large. And so I think that that is something that differentiates Middle Eastern LPs. First, the fact that they're all in business themselves, which adds an element of competition. And the second is that their major investment drive was outside of their own region. And no matter where you look, whether in the US or in Europe, that's not the case, because the regional LPs actually focus on their region first, on their countries first, and then they go international. And I think, and I want to stop here because, but I do have a couple of points that I want to make at a later stage. What I think, if we talk about the long-term future of private equity and venture capital in this region, in the Middle East, what in my mind could change or should change to make the future of this industry even brighter than I think it is at the moment.
I think just to jump in here and add to what Dr. Helmut was saying about the kind of idiosyncrasies of regional LPs, particularly the families. I think on that first point about them being potential, competitors of direct investors, I think there's also an additional dimension to that, is that what distinguishes to some degree the local LPs, especially the families, they are slightly more distrustful of funds and blind pools on the whole. So your first kind of hurdle to overcome when you're fundraising is going past this idea of like a blind pool. You'll invariably, particularly on the kind of smaller funds and the early stage funds or venture funds, maybe less so on private equity, they want to be involved in some. So always, commonly the conversation starts with, can I take a part of the GP? Can I take a piece of the GP? Can I be involved? Can I be on the IC? Can I, we've noticed, I think, over the past few years, as they deploy more and more locally, to, Dr. Helmut's second point around them, looking more locally now than they used to because of that diversification of risk point. They are keen on kind of being like an LP plus, like some kind of like strategic LP or so. So it is interesting seeing how, the local LP community is evolving, particularly the families compared to kind of the more global allocators.
It seems that in the West for the last 40 years, there is a certain, let's say, choreography has developed between the LPs and the GPs. There is actually a drive towards not having LPs as part of the investment committee, not having LPs in the shareholding of your GP, to maintain complete independence of any particular limited partner. So that's how the industry has evolved in the West. But in the Middle East, by the way, Southeast Asia is actually quite similar in many ways. That's not the case. So that choreography doesn't exist. In the West, when we raised capital for life science venture capital funds, nobody ever asked us to invest in the GP. Nobody really ever asked us in a big way to co-invest, make direct investments in the portfolio. But in the Middle East, that's very different, as you say.
Yeah. And I think as the industry evolves, this will change. But I think, there have been some instances where like fund managers have had some, like there's some, history to where, LPs are slightly bit more distrustful, but I think that's changing and evolving slowly over time, hopefully. And we're starting to see kind of more mature engagement, but historically, absolutely, that's been the case, I think, for all of us.
Just on the point about, just sort of adding to the points made about the traditional direction of investment, international versus regional. I do think, we're definitely getting a sense that is shifting, and it's actually been driven by, significant government support and economic policy, both, very much in the UAE, but in the wider region. So actually encouraging and stimulating economic diversification and growth in the region. And, that is a change, that is a structural change that's happened, over the last few years and will continue. And that is supporting investment, for example, into technology, into healthcare, into education in region, and that is developing demand from regional GPs, but as well as international. So it's not just the region now to look at asset raising. It's very much one to look at inward investment.
It's actually the first time it happens, in my observation. We've been fundraising for a long time. I have probably 30 years of fundraising experience. And it is the last, I wouldn't say the last couple of years. I tell you, from our point of view, the last 18 months have changed the picture entirely. And given the fact where fundraising is in the West for Middle Eastern funds, which is almost non-existent, if you ask me, because people have this, in the West, have this great distrust of the region because of all they hear on the media. It is actually the fact that Middle Eastern LPs have decided to focus more on the region, to support the regional development and growth, which is now becoming a very exciting part of their investment strategy. And in the wake of that, they also realize that they can't possibly do it all themselves and do it all through direct investments. So for the first time ever, I've been in the Middle East for a long time, they're actually actively considering investing in regional funds that do things that they could do themselves, which is actually a very exciting, if you think about it, a very exciting development for all of us. And the second point is that what I would hope for is that the sovereign wealth funds, the KIAs and the ADIAs and the OIAs and the QIAs, that they would actually embark on a similar region-centric strategy, which would actually call for their minimum in 100 million, but maybe 50 million or 30 million, in support of all these grassroots developments in the venture capital space, in the private equity space, because that would be an even more exciting development if the big guys would also embrace that concept.
Yeah, no, I think I agree. I think it's a super interesting time. There has definitely been a kind of paradigm shift in that kind of allocation strategy for the local investors. And, this is integral to developing a vibrant private capital ecosystem. So hopefully, long may it continue and accelerate, and hopefully the larger sovereigns also kind of jump in.
Well, thank you very much for all that interaction. You've completely made me redundant, which makes this really one of the the best panel discussions when I'm really not needed. But I will actually remind you of some of the questions that have come in. There's one specifically for Dr. Helmut. It's, how do you think regional funds can help the VC space in Middle East? If you'd be able to take that, please.
Regional funds helping the VC space. I don't quite get what regional fund is. Is it LPs or fund of funds? Regional funds of funds don't really exist. I do believe that the venture capital scene as we see today is the most exciting development that we are seeing in the region. And that has been going on for a number of years, obviously, and Dubai has emerged as one of the key locations for venture capital activity in the Middle East, and Riyadh is coming up quickly around the Vision 2030 and the government programs in Saudi. Lebanon got it started many years ago. So I think that grassroots development, which is all about innovation, new business models with a focus on the Middle East, but going international at some point, is actually a hugely exciting development. But what I said before holds true for this one as well. These funds are generally small because they can raise 20 million, 50 million, 70 million, 100 million, and they would be good sized funds for early stage Series A type of investments. But the local big investors, the sovereign wealth funds, they cannot invest based on their current strategies in things like this. But I believe if somebody wanted to really support the economic development and really use venture capital and private equity as a tool for doing it and attracting international talent to the Middle East, it would actually be super useful if special programs or special situations funds could be established by the big guys focus on that. And that would really help the venture capital industry in a big way, in my personal opinion.
We are already seeing elements of that to a certain extent, Dr. Helmut, right? The strategies that are coming out of the UAE and Dubai and Abu Dhabi, as well as in KSA. We're seeing developmental targets being funneled through even pockets, if you will, of the wider strategies into venture capital funds, into PE funds, the emergence of, when you talk specifically fund of funds, Jeddah is a specific MENA region focused fund of funds.
Correct.
You've got the SBC with their strategy, the DFDF backed by the DIFC, and their strategy and their carve out for a fund of funds element. And so we're seeing a lot of that starting to come through. Mubadala and ADQ have done that for years as well. And so there's actually quite a bit being done from a sovereign perspective. But additionally, we're seeing a lot of activity, I would say, from the larger family offices in the region as well. If you look, some of the best governance that we're seeing coming across family offices is what we're seeing in the region. Super top-notch portfolio allocation strategies, very clear intention in how they want to operate, how they want to interact with the ecosystem. I agree with Khaled. There is still an element of, we want to be part of the GP or sit on IC or what have you, but there's also the element of collaboration. How can we see the deal flow that you're seeing? How can we collaborate on co-investment? How can we work together to realize the opportunity that does exist in the region? And the region, if we broaden it to the Middle East and Africa by and large, is possibly one of the last frontier markets to exist now. A lot of other markets have, to a certain extent, quote unquote, emerged, but the opportunity set that we're seeing right now in the Middle East and Africa is unparalleled. We are super excited about what we're seeing here.
Yeah, I think I think the regional allocators are waking up to this idea that we're in the midst of a kind of generational shift in how these economies in the region, specifically in the GCC, but kind of on a broader basis as well, are structured. So this move away, directly or indirectly, from these kind of state-led economies, effectively to kind of these digitally native, entrepreneurial, business-led economies. So I think that's super interesting, and these allocators are starting to get it, and are beginning to kind of lean into it, as it were. And this is kind of informing some of their allocation strategies. So they're investing in what, whether you call it tech or non-tech. I mean, I would argue that the line is quite blurry between the two, but really about the innovative companies of the future, and they're doing that directly through funds, etc. So it's great to see them finally coming around to this idea of investing in the future of the region, because they see the opportunity as it's emerging.
Yeah, that's right. I mean, I think Saad mentioned the Dubai the Future District Fund. It's $300 million. It's housed. The manager sits in the DIFC. 50% of that is directly invested, 50% through VCs, and that was an initiative that was launched. It's going to be at least 3 or 4 years ago now, but it's very active, and that's some support. But we're also seeing VC firms set up in the DIFC. We have around 30 now that actually have funds domiciled in the center. So those funds are quite small. I mean, 20 million to 100 million. But they're all investing in the UAE and wider GCC. So yeah, we're definitely seeing that the VC ecosystem develop.
Thank you. Let me just jump in. We have a lot of questions from a very enthusiastic audience, so I'm just going to sort of summarize a few. A lot of us have picked up on the previous points on the expanding sort of direct investment interest, co-investment interest, more sophistication in the LPs, sort of participating alongside the GPs themselves. So could we talk a little bit more about that, since they are potentially also competing with GPs? Then what do they look at? Like what's the kind of way to approach them, and especially with family offices and sovereign wealth funds as well? Like how is that changing in terms of their strategy as they become bigger and also more sophisticated in their investing? Maybe we'll go to Dr. Helmut first, since I remember you had something to say on sovereign wealth funds.
Well, I think as we're sitting here, we're all too small for the sovereign wealth funds to really focus on us. I mean, saying what Said said before, I mean, Jeddah is of course, it's a notable example in Saudi for how things could be different. Special pool of capital, fund of funds. Their job is to invest in funds that focus on Saudi and in pursuit of Vision 2030. PIF itself, the mothership, would never have looked at our fund, and because we're too small. But these types of funds, 100 million, 50 million, 200 million, 300 million, that's what the region needs at the moment. This is where the entrepreneurial activity is. It is less so on the multi-billion-dollar fund strategies. It's more in the couple 100 million, 500 million, maybe 700, 300 million. That's a sweet spot, I believe, for private equity at the moment. And this is what we focus on. But yes, I would say I've been fundraising in the Middle East now very intensively for about a year. And I can say that about half of the family offices and investors, including institutions, want a particular co-investment element to their investment in the fund. And many of them are using the fund more or less to gain a foothold, to have a conversation with you as a GP about co-investing with you in deals that are larger than the fund can take. And some people negotiate particular rights to make allocations. And for us as GPs, it's always the art is to make that happen without actually disadvantaging other people. And so you have to always walk a very fine line. It's a multi-partite negotiation very often. And if you have established a rule of how you are going to engage with your LPs in terms of co-investing, then you need to try to make it a rule for everybody, so that there is no special rights and no preferences, and because other people don't take it lightly to not have the same advantages, always classical sort of most favored nations clauses, etc. So the element of co-investment in my mind, is particularly in the Middle East, is becoming very important. But I always, when we speak with investors, we always make them aware that if they really want to do it and not just negotiate it, then they have to be set up for it. And that means that they have to have the capability in-house and the capacity to evaluate transactions when they come across their desk, do it in a relatively short period of time, and give very succinct and clear feedback. Because as a GP, when you want to do a deal, you cannot wait for your LPs for 3 months, 4 months, 5 months to make a decision. It has to be very quick, because otherwise you can't fund your deal. And if you can't fund it from the LPs, you have to go outside and you have to syndicate with third parties. So there is a certain natural tension between these things, and that needs to be managed. But generally speaking, we think that the interest of regional investors in co-investing on balance is a positive, because it gives us more firepower. We can do more things. We can build bigger companies, and that's an advantage.
Yeah. Just one additional view on this is, like, again, fully agreed with everything Dr. Helmut said. I think one interesting aspect to consider here is on the co-investment side is obviously we're all GPs and we're all fund managers here, and worth considering the future evolution of our business model. I mean, this kind of this structure of investing in private capital has been around for 40, 50 years or so. I suspect that in the very long run, in the next 10, 15 years, 20 years, maybe longer, there will be more a move towards greater emphasis on kind of co-investment or ready access for LPs, rather than just kind of flowing through the fund. As syndication gets faster and easier and simpler with technology, as LPs get more comfortable with it, I suspect they'll start demanding more kind of direct flow through access. There's a question or a theory that maybe that we get there faster in the region compared to other markets. We kind of leapfrog that evolution because there's a more inbuilt distrust of funds, plus a historic kind of cultural interest in going direct all the time, where the GP becomes like, has a smaller balance sheet in the fund, but more of an intermediary, almost like an advisor or something like that. I can see this industry changing, and maybe the region might be more predisposed to that evolution, but we don't know. I mean, this is kind of topic that is ripe for kind of conversations, for like a debate all the time, and I'm curious to see how it plays out. But it's something to think about.
But we've been there before, right? I mean, we've seen deal by deal investment strategies in the Middle East, I believe, more often than in other places.
Exactly, yeah. And much more so, yeah, than other places, yeah.
Yeah, GPs, it's hell, because if you don't have a fund, nobody wants to pay for due diligence. So you invest $500,000 into due diligence, and you present deals, and then you have no idea if people like it and if there will be take-up. And that kind of, I mean, pledge funds have been invented, right? But pledge funds are almost as complicated as funds themselves.
Correct. Yeah.
And so for us, the business model, I've been thinking a lot about business model innovation, because I do think that we will be subject to forced innovation. If it's not coming from the inside, it's probably coming from our customers. But how to do it in a way where we respect our own needs, which is build a business, have management fee that is dependable, where you can build a team. Because in the end of the day, it's all about the quality of the people, about their motivation, about their alignment. And that's why people come to us. And if you can't afford that, what's the future of this industry, right?
Yeah, 100%. My main worry here is, and I'm not sure, is like we as VCs, we always talk about like disruption and investing in disruptive businesses. And I worry sometimes as a VC that we're missing the disruption in our own industry sometimes, or what it's coming. So that's I try to think about, but I have no good answers, unfortunately. I have no good foresight.
No.
Thank you. I just want to say that the questions just keep coming in. There are some categories that I think we should definitely try to address. There are questions around industries, which industries are most attractive right now that investors are looking at, and also what strategies. And by that, I think within venture capital, audience has raised about early stage as well as venture debt. I think both are very good questions, perhaps for Khaled, and then everyone else could jump in on industries. I kind of have a hunch on what Dr. Helmut's going to say, but definitely would love to, I think, hear from each of you.
Yeah.
Anyone would like to go first?
Not much I can add here.
In terms of kind of asset classes, I think, there's big room for private credit. I think that has a kind of interest, particularly venture debt, as the equity market matures for early stage investing, that will just naturally catch up. Becomes more interesting in this sort of interest rate environment for a variety of reasons. Also, especially within the segment of like embedded finance, fintech, you need like debt to be able to scale your operation. So I think that's interesting. I think there's a huge gap in what we call growth capital in VC. It's defined differently, but I think for us, the way we think about growth capital is basically late stage Series B and C, so tickets of 10 to 20 million in rounds of $40 to $50 million, especially, and these tend to be 1 to 2 rounds before exit. Our region companies don't usually go through so many rounds of financing before reaching a steady state or an exit. So 2 rounds, maybe pre-exit. I think that's a really interesting segment. There are very few, if not any, dedicated funds towards that. We're excited about all this. What the sovereigns and the local funds have done, local fund of funds or families have done, is really seed a lot of early stage fund managers. So you probably have too many individual fund managers, even though the AUMs are still quite small if you aggregate the asset class as a whole. But there are a lot of managers, and what that means is that relatively small amount across all the managers, but many of them, it means they've all focused on the early stage, which is great because it's seeded more and more companies, but then these companies reach a Series A, B, C, and then it becomes a bit difficult to raise, especially in an environment where the global funds are not as active here. So I think a huge opportunity is unlocking that kind of $10, $20 million concentrated, high conviction type of fund. I think there's big opportunities around that. So that's how I would think about, like, in terms of like the asset classes that are interesting.
I concur with that. Khalid, because in healthcare, I can tell you that and by the way, the focus on early stage, Series A startups is the same everywhere in the world. You had that in the US, you have it very much from a political perspective and subsidies, grants, schemes, support schemes in Europe. What people generally forget at the political level is that there is this valley of death when the VCs have been in there for 10 years, have spent all their money and need to exit. The company has just introduced the product in the market, which was approved. In healthcare, everything needs to be approved, right? So you need to go through an FDA approval or an EMA approval. Finally, you get there. And then people are out of steam. The old VC group wants to exit. For the big private equity houses, it's not a company because it doesn't have revenues or very small revenues. So it's not interesting. And that is exactly the space where what you're talking about. I think that's the same across industries. In healthcare, it's particularly pronounced. And that's why we are in growth capital. And that $10, $20, $30 million investment into the commercialization of a product or a service, that's where we play. And there's always a lot of technology involved, but we don't invest in technology. So in that sense, we are different from a VC. But I think, and I totally agree with you, growth capital is the biggest unmet need in the industry, and that is an international fact. It's not just in the Middle East.
100% agreed, totally. Yeah.
How about for venture debt or for private debt? Khalid, I think you mentioned earlier on that you're developing something along those lines, and it's really become a much more popular question, I think, after the recent collapse of the Silicon Valley Bank as well. So if you could just give us some of your views and insights, please.
So we're still obviously just thinking about it, but we think from our portfolio, and we're thinking about how we partner with different people to do it, because it's not we don't have the license to do it, so we need to think about how we do it. But we see, hearing from our portfolio companies and from the market, there's a real need, unmet need for credit. I mean, the region is a very peculiar kind of animal. It just tech and venture and private equity aside. This remains one of the least banked places on the planet, both for individuals and firms. And for firms, smaller firms, I saw a question somewhere how do you have a bank account? I mean, that's a good question. Like, it's very hard to even open a bank account, even for us, But even that aside, like access to debt and credit markets, very complex, very difficult. The traditional financial institutions just don't want to lend to anything subscale or perceived to be risky, even though if it's not necessarily risky compared to in other markets. So that's kind of compounded this huge empty kind of area, this huge gap where, private credit, and I mean this kind of generally writ large across private capital, not necessarily in venture, but venture debt particularly, because it's in the industry I play in. But I think you can see a huge need for that. And I think, there's a real opportunity to kind of help plug these gaps in the region that the kind of banking sector just, is just totally uninterested in across the GCC. So I think there's a big opening there. I know there are a couple of smallish private credit funds that are in the region. Some of the you have some global venture debt funds that are deploying regionally at scale, like this one, without naming names, but they're hugely deploying here because they're like, well, we see the opportunity, it's unbanked, we're going to fill it. And you saw like some of the big, even bulge bracket investment banks create products for the region, for like in BNPL, for example, in buy now, pay later. So I think the local investors are going to start waking up to that and start wanting to plug that gap as well. And so we're thinking about how we play in it. Obviously, it's different to what we do, and we probably wouldn't do it directly and figure out how we do it, but we're thinking about it.
Yeah, one of the challenges though is seeing the international players coming in. It's great news, right? They're plugging a gap, but there's also that missing element of local currency, where the need to hedge if you borrow in dollars and operate in a different currency becomes sort of quite a challenge. And so we are seeing the beginning of the emergence of local currency private credit providers, if you will, or venture debt providers. But again, even that, the spread needs to be managed. It needs to be something that companies can absorb before they can actually sort of go ahead. The gap to fund the float through non-dilutive financing is absolutely massive in the region, particularly when you look at fintech and embedded finance plays. The lack of banking solutions, quote unquote, is what's creating that massive need for it. And so, yeah, absolutely, I completely agree with Khaled and with Dr. Hamilton.
Thank you. I have some questions on risk. Could we talk a little bit about the major risks that we should be watching out for, whether it's PE or VC in the near term?
Well, beyond VC is risky business. I think like between 2020 and 2022, so many people forgot that this is like a high risk investment. Like, I think it became a bit like a carnival. But I think by nature, this is a very, very like risky instrument and needs to be like addressed as such. So I think within the embedded in the asset class, there's kind of systemic risk. In terms of overall market, I think, geopolitical risk has waned somewhat, but still exists. So we still have kind of geopolitical issues across the region. It's a bit better than it's been in the past 10 years, I would say, especially across, between the GC in the GCC and in the area in the region at large, with some kind of issues. So that's positive. I think obviously the long-term prospects for the price of oil is interesting for what it means for the region, how quickly that shifts and how quickly, because the region is going through this transformation, I think, towards more entrepreneur-led, non-state driven economies, but that is driven directly, indirectly through state investment, and the state requires a lot of capital to do that over the next 10-15 years. So it'll be interesting to see catches up to what and in what time frame. So that I think is a kind of overall risk. The regulators, both in Saudi and the UAE as the principal kind of economies here, have responded very positively across the board to kind of opening up liberalization and, incentivizing the development of, venture capital, but also like the companies themselves. So that still needs to kind of continue overall. I think that's super important. I think we'd love to see more, and this is kind of a risk in long-term kind of exit prospects. We still need to really have a fully, I would say, developed capital markets infrastructure that allows for more IPOs, a deeper market. We're seeing that in Tadawul, we're seeing that a little bit in Abu Dhabi and in Dubai, but I think it's still got a long way to go, and there's still a lot of regulatory reform that needs to be done. There's a lot of structural things that need to change. So we need that to happen, and there's some good positive stories recently that have emerged. We still have a long way to go to have a fully vibrant, private capital ecosystem that gets you to exit through IPO. So I think there's still a little bit there at the end of that funnel that needs to be done, and that's obviously see that as a potential risk, but we're cautiously optimistic that's going in the right direction, I'd say.
Yeah, I mean, just on Khaled's point about listings, certainly from the conversations we're having, we've never seen such high demand for MENA equities from global investors. We're getting feedback from sell-side investment research. They want to start, offering MENA coverage, and global investment banks said that the demand is unprecedented. And I think that we do have the infrastructure. I mean, there's Nasdaq Dubai, it's operating to international standards. You've got the liquidity. You have the capital market intermediaries, the big IPOs that we've seen in the region from sovereign assets. The books have been run from places like the DIFC. So that expertise is sitting locally. So the ingredients are all there for exit strategies, locally through local listings. We just need, as Khaled is saying, is build on that and make it happen.
Yeah, but even in thinking with that and thinking of risks, we do need to decouple markets like the UAE and Saudi from markets like some of those in North Africa and Sub-Saharan Africa, where you see systemic volatility coming through macro challenges, currency devaluation, you name it. The sort of joys of investing across emerging markets and the challenges that you need to price in when you're deploying. And so that's actually something that we need to think through as a risk and continue to mitigate for. And part of that from an asset allocator perspective is diversification, cross geography, cross sector, you name it. But also part of it is working with these companies to understand the notion of how to operate in different macro challenged environments.
Thank you very much. And I just want to pick up on the risk one more time. I think Khaled also mentioned we just came off a very high growth period, especially 2021. Activity was very high, valuations was very high. That has come down. Where does everybody see the downside risk from now? How do we look at the timing of making new investments from now?
Well, I think right now is a great time to make investments because of all the news that are pouring in and the inflation and the uncertainty. And generally speaking, valuations have come down, particularly in the tech sector internationally. Nothing short of a bloodbath in many particular sectors. For example, like in health tech, for example, which of course I'm quite close to. That gives us as VCs and private equity firms the opportunity to come in at very reasonable entry levels of valuation. And I tend to believe that, in this equation that we're trying to make here, one of the key elements is to have a reasonable entry valuation. And then, of course, you need to build companies for 5 years, 6 years, 8 years, whatever it is. And then you need to have a good exit market. So when you talk about risks, it's clearly at the moment, having money is fantastic. Unfortunately, it's very difficult to raise money at a time when you are in a fantastic environment to invest in. Interestingly, investors generally, I have observed over 30 years, tend to want to invest into what you do when the valuations are high, when everybody is making a lot of money from exits, when the stock market is hot, et cetera, et cetera. And then you can raise money as a GP, but that's also the worst time to invest. And so this is still a little bit out of sync. Fortunately, we have raised money, and so we are putting money to work. And I think that in the next 18 months, maybe until the end of 2024, I would expect that uncertainty will remain with us. And it will still be a great investment environment. And if you think longer term, I think the economic situation right now is good for investing. And I hope that what we just talked about, the development of Tadawul, of the stock markets in Abu Dhabi, in Dubai, it would be hugely important for all of us in 5, 6, 7 years, because that's the time when we are looking towards exiting from the investments we're making now. And if we had capital markets that from the regulation point of view, from the focus point of view, would allow growth companies, technology companies, that would be a hugely exciting environment to be in.
Thank you very much, Dr. Hellman. I think that's actually a great concluding statement for our panel today, because I believe we are also out of time now to address all the questions. Wonderful questions came in. I'd really like to thank the audience for being very engaged and very enthusiastic in sending us all your questions. On behalf of Preqin and the DIFC, I'd really like to thank our panelists for this very insightful discussion around the future of PE and VC in the Middle East. And of course, a big thank you once again to the audience for joining us today. Preqin and the DIFC are launching a joint report on the future of private equity and venture capital, which we will be sending you by email in the coming days. Oh, here's the QR code for my slides if you're interested. Our reports come from our Preqin Pro platform. It's going to provide you access to the industry's most comprehensive private capital and hedge funds data sets, as well as analytical tools. I sincerely hope that our sharing today has been useful for you, and I hope that the remainder of your day is fruitful and enjoyable. So thank you very much.
Thank you. Thank you.
Thank
Thank
you.
you.
Thank you so much.